Welcome back. One of the interesting developments in the financial markets over the past day or so is the VIX, the Volatility Index, which has crossed above the 20 level for the first time in a long time. The white line here shows us the S&P 500, which certainly has been weak as of late. The red histogram bar shows the VIX, the Volatility Index. The reason we mention is the 20 level is a pretty important pivot point and we'll show exactly what this means in the past. The VIX is an indicator. It's made up of the front month options, those options in the S&P 500 that are set to expire the soonest, and it measures the premiums on those options. So essentially, when the stock market goes up, we don't use many options to hedge our positions, but when the market goes down, option prices, the premiums go up. Here, the red histogram bars show us the number of days the S&P 500 trended higher as the VIX remained below 20. We were at over 100 trading days with the VIX consecutively below the 20 level. This all ended in the past day. What does this mean? Well, go back to the year 2007. We saw the VIX, and it actually was it was a longer streak that took place, but this is the end of the streak of the VIX below the 20 level around October of '07. The white is a line is a S&P 500, which was around 1550. And as the VIX crossed above 20, this started the big sell-off that we know of that it transpired later on in 2008. But before that occurred, the S&P 500 went from 1550 down to the 1400 level, all starting at the beginning when the VIX crossed above 20 for the first time, ending that long streak. We take a look at 2015, the VIX was below 20 for 140 trading days, which all ended around August of 2015, and the S&P 500 very quickly dropped from 2100 down to around 1875, rallied back up, and then fell even lower down. We fast forward to 2020, the COVID crisis. Well, before that occurred, we had the VIX below 20 for about 90 consecutive trading days. And very quickly, as the VIX crossed above 20, the S&P 500 dropped from 3,400 down to around 2,200. Now, this does not mean that the market's going to precipitously drop the same way it did back in 2007 and 2020. But crossing above 20 does indicate that the market has changed its tempo, so to speak, and we're entering a period that is a little bit more, it's marked with a little bit more market uncertainty. Here are the average monthly performances of the S&P 500, and this data goes back several decades, so we have a lot of numbers to crunch here. But when we have a VIX between 5 and 10, we on average tend to see the S&P 500 return around 2.1% a month. Now, if you extrapolate that out, 2.2% a month, that gives around a 24% return on investment for the year. Of course, a VIX is rarely between 5 and 10, but those are the figures. Between 10 and 20, or 10 and 15, I should say, that is probably one of the most common areas between 10 and 20. Well, 10 to 15 averages around 1.9% monthly performance on the S&P 500. Between 15 and 20, 1.1%. Between 20 and 25, around 0.5%. But when we see the VIX between a 25 to 30 level, 30 to 35, or 35 to 40, we see negative returns. Point being is that the VIX below 20 is really the level we want to see if we expect to see strong market performance, or at least positive market performance over the course of the month. And to go back to present date again, the VIX crosses above 20. It's the first time we've seen this in the past 100 trading days. Again, it does not necessarily mean the market's going to, sell off as fast as it did in 2015 or 2008 or 2020, but it does mark a different trend that the S&P 500 has entered. It's not a strong market trend. It could be a sideways trend. It also very well could be a very weak trend as well. But it's important to note because this is a development which has just taken place. And we're going to continue to watch this and many other indicators, and we'll be sure to update you with any significant developments along the way. We hope this has been helpful. We look forward to seeing you back soon.